Why do retail investors always lose money? I am going to answer this question in 4 aspects. What is the nature of stocks as investment products? Which stocks have upside potential? What's 4 misunderstandings that lead to losing money? What is the most dangerous traps in the stock market? After understanding these 4 aspects, I believe everyone will understand why we always lose money as retail investors. This will be a series of videos. Firstly, we will talk about the nature of stocks. Some people say that stocks are cheap, like chips for gambling in casino. Others say that stock is a certificate which proves you own a part of the company. Both answers are correct. For people with different ideas, the nature of stocks is different. For those who treat the stock market as a gambling house, stocks are a kind of chip. This is especially the case with short-term investors. And for those who are bullish on the company's future, thus buy the company's stock, they will become shareholder. It can be said that when you buy stocks, you are equivalent to buying a part of the company. You can share the bonus as the company grows, and you also have the right to receive dividends. This is the case for long-term investors. Therefore, the nature of stocks depends on your stock trading philosophy. But whether you are here to gamble or invest, the ultimate goal is to preserve and increase the value of your own wealth. But, if everyone makes money, where does the money come from? The stock market is not a charitable organization. It is impossible for everyone to make money. So, let's talk about the first money source. If a country's economy continues to rise, then the country's stock market, as a whole, is a positive-sum game. The overall market continues to grow, the company keep on expanding, and the operating income generated continues to increase, thereby the money you earned is from the appreciation of the stock market. The second source is the more intense zero-sum game. For example, if what you earn on a stock beat the market alpha return, then the extra money you earn is someone else's money. And these others must have earned less than market. Therefore, if you want the alpha return and you want to buy low and sell high, you have to go through bloody competition and take money from others' pockets, but at the same time, you also face the risk of being harvested by stronger competitors. In conclusion, stocks are both chips and certificates. The money you earn from stocks can either come from the overall development of the market or through bloody snatch. The difficulties differ by the stock trading philosophy and ways to make money. If your stock philosophy doesn't match your stock strategy, it is highly possible you will lose money.